Hello, everyone. Welcome to another episode of The Bridge, the official 107capital podcast. My name, as always, is Tyler, and this is our founder and CEO, Timnihill. And today we are going to be talking about something you've been looking forward to for quite a while, haven't you?
401ks.
But specifically a facet of the 401k industry. Now, for those who don't know, Tim was very heavily involved in the 401k industry in its burgeoning years, especially behind the scenes at a number of different companies. He's going to talk a lot about that today, but more in particular about really how the 401k industry and the concept as a whole got hijacked.
Yeah.
I mean, where do you even begin?
401ks are such a hot topic. It's so awesome. It is where do you begin? Because everyone right now has this concept of retirement that, all right, I need to save up over a period from, let's say, 21. It's starting younger, right? Because kids are working at 14 now, which is weird. Like, why are our kids working at such young ages? It doesn't make any sense to me. I get teaching values and crap, but I think we're going a little bit too far. So the problem is there's this concept of retirement where you are going to save from the age of 21 all the way to the age of 65. Now if BlackRock tells you 72. And then you're going to work for 50 years basically. And then finally you're going to quit working forever, live off of everything you've accumulated, and hope you have enough until the day you die and pass on to heirs and whatever. So I don't know where this concept came from. As a good friend of mine laughs at, and he's a retired advisor and he sold his practice because he just saw the mental health issues that retirees have within the first 5 years of retirement.
I'll look it up because now I'm curious.
It's he quit the business because of it. Because he learned that retirement planning is bogus.
It was created following the Revenue Act of 1978, but it officially began in 81.
Right. So pensions are going away. You have this supplementary account called a 401k, and you have this concept that really I think financial organizations made up in order to gather assets and charge fees. Right? So you're supposed to spend your life energy working all of the time, and then one day you get to sit back, relax, and chill. Well, what's happening by that point in time is everyone's burned out. Mm-hmm. I mean, just go to any retirement community, nursing home, blah, 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 whatever. It's like, yeah, they're having fun, but it's such... the energy level is so low at that point in time.
It's just a sad existence.
Yeah, it's you're at the end of your physical form and life form, and then all of a sudden it's like, oh, now I'm going to start seeing the world, now I'm going to start traveling. Like, you should be doing this stuff constantly through your entire life. Mm-hmm. Like, why are you delaying living? And so as this whole thing is developed on the retirement side, now you have pensions got killed through the 70s, 80s, and 90s. They eventually passed the Pension Protection Act, which wiped pensions out pretty much completely. And
ironic name.
Yeah, and then you had this thing called a 401k, which is meant as a supplemental retirement account, which is meant to supplement your pension. That is the default account to save for retirement. Mm-hmm. And the problem is, too, it's like, okay, I can accumulate, let's say I can accumulate $5 million in a 401k. Under today's tax code, $5 million minus 50%, because you have to live off that money, so you're paying income taxes. And it's just this weird systematic cycle that retirement has become, where everybody's waking up to the fact that they don't work. They were absolutely hijacked with the Pension Protection Act of 2008 because it gave investment management firms and insurance firms, I'm not saying it's bad, but the ability to auto-enroll auto escalate, auto default into financial instruments, which, by the way, I worked with the people who invented target date funds. They're an experiment. They've never been tested. So it's like you're taking your entire life's work and people are putting away 5, 10, 15, 20% of their earnings, which is their effort, into an account where it's being managed by massive firms that are generating massive amount of revenues, and they get to take more money from you without your consent every year, and then have zero fiduciary liability and risk.
Literally,
because they literally wrote the risk and put it back on the plan sponsor and the administrator.
So literally in these agreements, it says that the firm managing has zero fiduciary responsibility.
No, it's not even in the agreements. It's in the Pension Protection Act of 2008 under Qualified Default Investment Alternative Exemption.
So it's in the law itself.
It's the law itself. So if you look at, I find it interesting, if you look at the collapse of 2008 and all of a sudden this comes out, well, who needed the most money at that point in time?
The banks.
The banks and the investment firms, because they all went bankrupt. Remember Merrill Lynch?
Yeah, unfortunately.
It's now Bank of America at this time. So is it outside the realm of possibility to say, hey, a lot of people got together and say, we need to cover our asses. How do we get the most money in the least amount of time over the next 10 years? How about this idea here? Let's get everyone's 401k.
So walk me through, before we get into that, before we get into exactly how the banks hijacked it and what they did to hijack it, walk me through where you come in. Did you come in before the hijacking happened, as it was happening, or after it happened?
Oh, we were in the industry way before.
So how did you come into the 401k space, and what did you contribute to it?
Well, I mean, if you want to go to that, I mean, I basically helped build the 401k industry. I worked at, a broker-dealer that's a top independent broker-dealer in the space at the time. A bunch of us got together and said being a fiduciary and being an ERISA fiduciary would be a really, really good idea. Partnered up with a friend of mine, Marshall Wagner, at the time, because everyone was looking at what we were doing. They're like, who the hell is this kid and what's he doing? Because I was on panels with the brass from Morgan Stanley and LPL and Ray J and all those firms, and they had no answers for the 401k because advisors were trying to figure out how to start working with them, and we had the answer. And I went on a panel down in Boston one day, and I'm some 25-year-old little shit in a chair, and these people have been in the industry for 40 years, and I'm running circles around them. It was kind of a shock and awe, like, holy shit, what are these people doing?
Mm-hmm.
And then I told everyone else how to do it. And then we went and started distributing 401ks and being the first ERISA fiduciaries in the country. And then, 08 happened with the passing of the Pension Protection Act. I helped build the largest network of independent advisors that now manages over $1.3 trillion in retirement assets. And then I got bought by iShares and BlackRock.
So is that when the hijacking began?
2008. And so it went from becoming what was in the best interest of the individual and the investor to a very legalized process.
Mm-hmm.
And the legalized process became around not what's in the best interest of the investor, it's what's in the best interest of the fiduciary. And what's in the best interest ultimately of the investment firm. Because all 401k decisions became commoditized, and it's all based on fees.
If you can even call them fiduciaries.
They're all fiduciaries.
Mm-hmm.
Yeah, if you're working with 401ks, you're a fiduciary. There's no question about that. And that's why we did what we did. So like you're in a 401k as an investor, and I tell you every day, like nobody has any idea what the hell a target date fund is. Nobody. And yet there are trillions of dollars going into this thing. And I really believe that it became a free ride for financial firms to gather assets and charge fees.
It's sort of like the retirement version.
It no longer became about the participant and maximizing retirement, because there was an entire wave happening organically in the industry where everyone had fully transparent, fully open architecture solutions with managed accounts, by the way, which you do in the wealth management space. Managed accounts, every single asset class, stocks, bonds, mutual funds, ETFs, whatever you want. And don't let them tell you they can't buy ETFs. They can. They just refuse to get off the technology systems they have. And all of a sudden, here comes, packaged products from Wall Street, bailing out bad debts in the industry as a whole. And everyone that puts $1 in a 401k essentially has bailed out Wall Street. On top of what they did outside of the industry in too big to fail and everything else. So the point is, killed pensions. You basically have no Social Security because that's dead. And then now you have to pray that you can accumulate enough and make enough in the markets, which are, by the way, completely manipulated. And you hope to God that 50 years from now, this thing's high enough that you can live off of.
Mm-hmm. So
it is the ultimate hope and prayer strategy now.
Yeah.
And the real work that was getting done is no longer getting done. So, no, I am not a fan of 401ks. I also don't think, and I think this is widely mistaken, that to think that you should be paying and having your highest tax bills at the time where you make your least amount of money is a really, really bad and scary idea.
Well, you have to ask yourself, why do they do it that way? What's the motive there?
You're marketed.
Mm-hmm.
You're told with the green line, orange dollar, all this other good stuff that this is how it should be. But when you really sit down and run the numbers, you understand that there's not a chance in hell you can accumulate enough money, given the bandwidth and the limitations you have at contribution, to secure your financial freedom in 50 years. Mm-hmm. Based on this account. And it's a hope and dream strategy. But everyone's told it's tax efficient because it's tax deferred. Your taxes are going to be higher in retirement or lower in retirement. Boom, wrong. By the way, what don't they tell you? The dollar is 100,000 % less value 50 years from now than it is today. They don't include that in the math. And don't tell me for a second that if I have $100,000 and I save it and it becomes $1 million, that I'm better off paying income taxes at 40 to 50% on that money versus paying 15 to 20% over the annual growth of that 900,000. Mm-hmm. I can replicate tax efficiency and do tax efficient investing way better than any tax deferred retirement account and way better than any 529 plan. And oh, by the way, it's not a liability because a retirement account, especially until you're 59 and a half, is not an asset. It's a liability. Get a divorce, see what happens to that account.
Mm-hmm. Now here's...
Oh, and by the way, if something happens that I'm not planned for and I need extra cash and I have nowhere to go because I'm 401k heavy, where does the cash come from? Well, I either have to take a loan out, which is fine, because you're also told not to do that because if everyone takes loans out from their 401k, financial firms can't make their asset under management fee on your money. Therefore, they're trying to protect their revenues and not tell you what's in your best interest. And if you learn about loan features and how to use a 401k and maximize the loans, especially over your lifetime, and you have that liquidity inside the 401k, your chances of having a better retirement are 10 times higher than if you try to find the money from somewhere else.
And we'll come back to that for sure. I want to kind of loop back to where you factor into this whole thing. Now, obviously, you've mentioned, how you got into the industry to start. Where were you when the hijacking began? And what did you see from the ground? After that, we can talk about, what exactly they did. But I'm kind of wondering what your perspective was, where you were at the time.
What that allowed for, because as a business owner, you're trying to find someone that can manage your 401k, right? You want to offer the benefit.
Yeah.
As a business owner, because it's an incredible tax deduction.
Yeah. So where were you when it happened?
What do you mean? I was at the broker-dealer.
I know, like, how did you perceive it as it was happening?
I thought it was bullshit.
Simple.
Yeah, it was bullshit. I'm like, this is awful. I'm sorry, but target dates are dog crap. And there will be a massive lawsuit coming in some way, shape, or form. And that's only if the 401k industry can last long enough to get there. Because right now, think about this. If you eliminate income tax, why would you ever put $1 in a 401k?
There's no reason to.
There's zero reason to. So the 401k industry is going to get what it rightfully deserves. It needs to be cleaned out. And everything happens. Like every if you read Jim Collins' books, like From Good to Great, every idea has a life cycle, right? It's an idea, it turns into a revolution, becomes a business, and ultimately ends up a racket. And you saw it with pensions. You see it now with 401ks and retirement planning. And you're going to see the 401ks go away for something new.
Mm-hmm. Do you think we're sort of in that moment right now where the 401ks are going away?
Yeah, they're going away. The second that Washington votes to get rid of income taxes because the money's coming in through tariffs or wherever else, it's gone. And I mean, and that's the other thing that hijacked is you went from having complete open architecture, like in my managed accounts, right? Mm-hmm. And in managed accounts outside of 401ks, because when you have access to private equity, private credit, etc., like you could destroy a target date fund. On top of that, you can manage risk better. There's no risk management in these things. Go back and look at what happened in 2008. Yeah. Look at how, at that time, the target date team at BlackRock,
here we go,
who was competing with Vanguard on the institutional side, this is the sales pitch. In the 2008 crash and recovery, BlackRock, as compared to Vanguard, only lost participants 4 years in their retirement savings versus 10. That's the sales pitch. And I might have real estate and commodity exposure and they don't.
It's like I crashed my car and I only popped a tire as opposed to the car being totaled. Right. There's still damage.
Right. And then you go behind the scenes and every time there's a competition over, especially the institutional side with large dollars, big companies, like a Boston Scientific and Target and all that good stuff. Like, once you start losing accounts at that level, guess what happens? Let's go to the back room and change the mix of our target date fund.
They literally started losing accounts.
Well, we win them from other people. Yeah, that's why we have salespeople.
My goodness.
And they have, trust me, the sales goals I did at BlackRock, on average at least, I would say probably like 1.3 to 1.5 billion in new assets a year. And that was only if it was an individual thing. Once it became a team thing and I built a couple new things, the assets were way higher. Mm-hmm. Like raising $10 billion a year, not a problem.
So this brings me back to...
And that's a part is the other thing is, I don't believe your 401k and your retirement plan, or your future life plan, let's say, your future life plan should not be based in a casino, in the markets.
Oh, yeah.
Can't be there. So there's strike one. Strike two is you have to have the exposures and the investments that you need and the liquidity. And 401ks don't give you that. Mm-hmm. And your retirement, your future life plan should not be dependent on the whims of a financial organization and them competing with other financial organizations for big money. If there's something that to me says lack of fiduciary responsibility, like there you go. Mm-hmm. And the worst thing about ERISA fiduciary responsibility is when you take and you're an ERISA fiduciary on a retirement account or a health benefit account under ERISA, you're professionally and personally liable for the losses. Except Wall Street, because they were given a free ride.
Now, speaking of
and it's true.
Now, speaking of Wall Street and tying back to what we've kind of skirted around this entire time, you've mentioned the big impact that target date funds had on this entire hijacking, I'm kind of wondering, I think now let's get into the meat of it. Kind of like Big Short this for me. What is a target date fund? How does it work structurally? And how did they use it to hijack the industry? What did they accomplish with it?
The theory behind it is it's a customized asset allocation solution for retirees and people saving for retirement in the 401k. So in theory, if you take statistics and you apply a glide path where the investments and the allocation de-risk over time and get less risky the older you get, right? Because you're managing to the age of 65, 67, 72.
Mm-hmm.
So you're basically you're managing a risk tolerance. I mean, you're stereotyping everyone, right? Basically.
Yeah.
And you're putting people where naturally over time the allocation gets less risky from equities to bonds to cash. So it's 90% aggressive when you're 20 and it's 20% aggressive when you're 65, 67, 72.
Mm-hmm.
And then the number that they say from the math at the time was you need to earn 37% return year over year in retirement. You should have 37% exposure to equities in retirement to have that money carry you through your entire lifespan based on those assumptions at that time. The problem is when it becomes a sales machine, you have to tweak your glide paths and you have to tweak your asset allocations to win money and win, and earn revenue. So it's a sales machine now.
So they started to tweak the glide paths. They started to tweak the asset allocations.
At the time when
that's when they saw the opportunity.
Fidelity would change it every 4 or 5 years. And I mean, the gold standard in the institutional space is Vanguard and BlackRock. Well, one, because they're cheap index funds. So great, you have a default in my 401k that, oh, by the way, no one's managing. It's all passive. There's no one managing it.
Defeats the point.
It's
supposed to be managed.
It's not managed at all. Oh, it's set on the financial churning system of rebalancing every quarter. It's how finance works, man. It's how this packaged product stuff works.
So that's how that happened. Is they basically saw the opportunity to change the glide paths, change the asset allocation. It wasn't even that.
So you have qualified default investment alternatives, right?
Mm-hmm.
So here's how the decisions are made in the 401k space. For the most part, you don't have this issue so much with smaller, some medium-sized companies because there's someone like me in the background making sure that this doesn't happen, right? But so for example, if you're with a company and they're with a financial firm, you have this package product and you have a lineup of 15, maybe 20 mutual funds.
Yeah.
And they sleeve a target date funds. So what they had at the time is the qualified default investment alternative. Not to bore everybody with this, but I guess curious minds want to know. It could be a target date fund, an asset allocation fund, which is, conservative, moderate, aggressive.
Mm-hmm.
So risk tolerance based, or it could be a managed account managed by an outsourced professional, third party.
Okay.
Which we have those that we plug into people's 401k accounts, right? So the problem is you can't, with the way that the sales process works in the 401k space, it's all based on taking your plan to market, and it's very government-like, right? One time when I did a proposal, I was, for an old town I used to live in, I was a board member for their golf course, the town golf course.
Mm-hmm. Very local.
We took this place from losing a ton of money to profitable, which was amazing. And we turned it into a profit margin for the town. And like we would go in front of the town council, like, wait a minute, you're making all this money? We did the same thing with we did the same thing in the initial days of the 401k space.
Mm-hmm.
401ks used to be a loss leader to selling wealth management and financial planning.
Yeah.
Because everyone, it became it's got to be the cheapest thing out there.
Mm-hmm.
I don't want cheap. I want success. Is there any time that success comes cheaply?
No.
Like, so why are you cheaping out on your financial success?
Exactly.
And so, like with the golf course, we went to take our maintenance to market, and the people we had at the time were awful. And we found this group out of California. They're a big firm. They were expanding into the New England region. And we're like, oh, yeah, it costs more money, but what they were going to do is this course would have been phenomenal. Now here I am. I'm doing this with my free time. I go through this entire freaking process, which took months, by the way, right?
Mm-hmm.
And we get to the bottom line, and we have to go with the cheapest one.
So are you
flipping serious?
You did the whole thing just to get to the end, and then you realize you can't do it.
Right. So 401ks are sold to the cheapest manufacturer, and there you go. There's your retirement, and that's your future life plan. So yeah, I think 401ks are a problem, but I also think they're going away.
So let's wrap up with a discussion on that, because you mentioned a little bit about this in our previous episode when we talked more about how retirement as a whole, that whole concept is flawed. Let's zero in on 401ks. What is the nature exactly of the quote unquote going away? How are they disappearing? How is that manifesting in a structural sense? And what is replacing them?
What's replacing it is crypto. Digital assets. Everybody out there in finance especially thinks it's this little shiny toy, and what they don't understand is it's going to put them out of business. It's a done deal. So here's an example. Work with people in technology, right? And they have successful technology projects, and that technology pays them out, I don't know, a good lump sum of money.
Mm-hmm.
First and foremost, if you're successful on a project and you get paid a bunch of money, what's a $20,000 tax deferral going to do for you?
Probably not that much.
When you're staring down the pipeline of a 7-figure tax bill.
Yeah.
Pretty sure that 401ks are not the most tax efficient machine out there. So retirement accounts don't work. And the younger generation, are you going to work till you're 72?
No.
Why not?
Because no one wants to do that. That's a horrible, horrible life.
Right.
People who are 72 don't want to be working when they're 72. You ever met a person at a cash register at a grocery store who's like a senior? They either hate their life or they have just given up.
Yeah, and I'm sure somewhere along the lines they bought an annuity or bought a 401k. And the annuities are the same problem, by the way. But we could talk about that one later.
Mm-hmm.
Theoretically, in concept and idea, but not a very good one. So, anyways, you don't want to work till you're 72. The entire concept with young people is going away. You have the age of information and technology coming, and honestly, I think universal income is coming very, very soon.
You keep saying it's coming. Really, it's already here.
Yeah, and at the same time, you have Trump and all these guys who are a lot of Wall Street guys, but they're a different side of Wall Street. They're not looking at it saying, well, if we could raise enough money and make enough money in America again and return it to pre-1916 economics before our system and our constitutional republic was hijacked by a bunch of socialists, and we're going to unwind everything that's been built since 1930, And it's not even that it's been unwound, it just collapsed. So you don't conceptually have the same things going forward. You cannot tell me that, especially when you look like someone who, Jack Mahler's at strike, right? Jack Mahler's has no interest in a 401k. You out of your mind? You're going to try to sell him a 401k when he's a Bitcoin maxi? Right? Like, and these are the visions that younger generations are starting to have, because they're realizing that I can make a lot of money now and be successful now.
Mm.
And I don't have to have a 401k because I have properly built my family office, so I don't have to wait. Right?
Yeah.
I know with where I am today, I'm done. Trust me, I busted my ass through the whole process and went through things that people can't imagine, and one day I'll maybe talk about divorce and family law. And
that'll be a fun one.
I'm sorry, but when you go to networking events and you watch attorneys drink scotch and then toast over how much they can get out of each case and watch them run each case up to that number and then finally get it done, you'll rethink marriage across the board and family law.
Mm-hmm.
Maybe we will talk about divorce, and we should bring your mom on for that, because her divorce financial planning business is massive.
Yeah.
And
it's not a bad idea.
And in her life transition business. So, yeah, 401ks are toast, man. There's no liquidity to them. They can't out-earn the next stage of technology and finance, which is digital assets. And people can tell you till they're blue in the face, you have a $4 trillion industry that's about to go to $250 trillion plus. And a lot of the younger generation is in it. And they're going to benefit from it, and they're not going to buy 401ks.
Mm-hmm.
They're going to need to build family offices, but they're not going to buy 401ks.
And even those, even those who are not in digital assets yet are still not in 401ks. No one, like
Right.
whether or not you understand digital assets, everyone, I think, at this point understands how horrible a 401k is. Like,
Smart.
if not DAs, then like I know a lot of people who have like a Roth, for example.
Roth, I love Roth because it's tax-free. That's different. The Roth 401k is the only 401k I would ever put money in. And the other thing with the 401ks are, conceptually, it is not only going away, but systematically it is. When they eliminate taxes and income taxes, well, no one's going to put money in a 401k again. And then if I don't have to pay income taxes, please, man, I'm cashing out every tax-deferred account I have.
That implies the government is going to give up any source of revenue. That's a big if.
Well, they apparently think they have it replaced somewhere else. And when you control money printing, you can do whatever you want.
Hey, whether they're right or not, if they get rid of it, they get rid of it. That would be great.
Don't sleep on how big this systematic change is, and you can't sleep on the fact that 401k plans and tax-deferred accounts, and even 403bs and 457s that are not pensions, not only do they not work, but it's not a tax planning strategy. So you have to start thinking like a wealthy person.
Exactly.
When you're out there in the mass affluent market, the status quo is unachievable in retirement. Don't believe me? Go to these retirement communities, go to these nursing homes. They all had financial advisors. They all had 401ks and annuities, and they're all broke.
Go to Target. Go ask Deborah at the cash register.
Right. And that's the other thing. It's like, now with these accounts, you used to have longevity planning built in, right? Because you used to do what's called a stretch IRA, where your beneficiaries in the next generation could inherit the accounts and then take systematic payments and distributions over their lifetime, where if you have the right investment solution, that money will never run out, because the way the math works is the math is built to go to zero at the age of 108. But the IRS changes its longevity tables to try to keep up with humanity.
They're literally estimating when you're going to die.
Right, but if I can give that sum because I never touch it, right? to the next generation and they can have lifetime income off of it, that's a planning tool. Mm-hmm. I could take that. But we killed that, didn't we? When the crooks in D.C. under Joe Biden decided, nope, everybody has to cash out in 5 years. So, okay, when you're a beneficiary on a 401k and you inherit $1 million and you have to distribute $1 million in 5 years, that's $200,000 a year over a 5-year period of time. Tell me about your tax bill.
That is a hefty tax bill.
Yep. Government got greedy. 401ks and retirement accounts are going away.
Part of it is also part of it, if anything, is like a last gasp. Like they have to. It's sort of like a survival instinct. Their back's against the wall.
Yeah.
That's where we're at.
No, I mean, I just, systematically, the entire system's broken, right? Because there's no Medicare, Medicaid, and Social Security money. Mm-hmm. Like, everyone, I don't know where it all went wrong, but there's, like, no fiscal responsibility in the entire thing. Mm-hmm. And so, it always happens throughout history. It needs and is going away. And that's why you're seeing this revolution in technology and AI, and now we're seeing all these wars and stuff. Everything we've had for 100 years has collapsed, and it's like we just talked about. I'm not working until I'm 72 to just kick back my feet and be done. Like, mm-hmm. I can make money for eternity. Right?
Yeah, I mean, even now...
I don't know that I would ever not do what I like to do.
Yeah, I mean, even now, statesmen are talking about a new world order. Like, people, even inside the system, are recognizing, oh God, the House of Cards is falling.
Yeah. Yeah. Who was in that? Was that Kevin Spacey, House of Cards, that show?
I mean, that was a show. I was referring to an actual conference that was given... where there were a bunch of world leaders and they were talking about it. Although the original
old world order fell, so now we get a new world order that's also not going to be there.
The original House of Cards, though, was in the UK, and they adapted it to the US. Like,
yeah, I mean, I share this with people, right? Because mm-hmm. I mean, you think about it from a human perspective. There's so much going on right now. And there's so much information that everyone has access to. And half the time you don't even know if it's accurate or not. And I could tell you there's family office work is coming to the masses. And there's people that do family office work and then those that are posing as family office people. So if you really want to find out and figure out how do you know if you're with people that are actually doing the work with people that are not. Mm-hmm. If they're solo or one of their tax recommendations, because this is taught in family office school, I mean, there's actually a class that people take, mm-hmm. Which means it's not even family office work. So if they're like, oh, I'm going to manage my taxes with 401k strategy and we're going to do tax efficient investing, not tax efficient investing, but tax loss harvesting. And you should have your own LLC and be your own LLC. No. Sorry. That's not where a family office starts. There's a whole other level above that.
Mm-hmm. And we'll talk about that level in the near future for sure.
So it's it's definitely it's definitely coming, and 401ks are not a part of it. Like, I cannot explain how many conversations I'm having with people now that understand that systematically there's a problem. This concept of retirement planning and financial planning, like, if you want to have an advisor and find someone who's thinking about the future, have them talk to you about really what financial planning is.
Exactly.
And wealth management is. Because it's not some pretty 80-page document running Monte Carlo simulations.
I think that's a good way to sum it up.
Right. So that's where the 401k is gone.
But I think that being said, I think we've crossed the bridge for today. Anything else you want to add?
So next time we talk about family office stuff.
Yeah, more specifically, because we've talked about it before, but more specifically, how it's coming to the masses.
Yeah,
Because I
for
think
sure.
we can go into more detail on that. I think, obviously, our listeners are going to want to know about that.
Yeah, and a little bit of a teaser is how do you become structured generationally like the Rockefellers did, like other large families did.
So stay tuned for that. But as always, my name is Tyler, and
Tim, good to see you.
we will see you next week. Cheers.